In the first quarter of 2020, OMV took a major step to extend its value chain towards higher-value chemical products by reaching an agreement to increase its shareholding in Borealis to 75% for the purchase price of $4.68 billion. The transaction is expected to close by the end of 2020 and is subject to regulatory approvals. In order to finance this major acquisition, OMV announced a €2 billion divestment program to be realized by 2021, which also includes the sale of the OMV filling station business in Germany and the 51% stake in OMV's gas logistics subsidiary, Gas Connect Austria. This acquisition will turn OMV into a global oil, gas, and chemicals group whose integrated business model extends from the wellhead to high-quality plastic products and repositions the group for a low-carbon future. At the same time, the global spread of the coronavirus not only abruptly changed people's lives, but also had a severely negative impact on the global business environment. OMV is responding to this situation by embracing responsibility for its employees, the customers who rely on the security of supply, and for society through its support for aid organizations. OMV has approved an action plan worth more than €4 billion to protect its financial strength. This includes a reduction in organic investments of more than €600 million, a cut of more than 25% compared with the originally planned €2.4 billion, cutting operating expenses and exploration costs by around €200 million, and delaying investment in acquisition projects totaling €1.5 billion. Moreover, OMV and Mubadala have agreed that OMV pay the purchase price for the additional Borealis shares in 2 tranches, whereby more than €2 billion do not fall due until the end of 2021. And now, let's take a closer look at the figures. The clean CCS operating result decreased by 8% to €699 million in the first quarter. This is still a good result in light of the circumstances. Lower realized oil and gas prices, as well as lower demand caused by the coronavirus pandemic, negatively impacted the result. Upstream earnings were particularly hard hit by lower realized oil and gas prices and by write-offs of exploration and appraisal wells. A surplus of oil and gas caused the average Brent price to decrease by 21% against the first quarter of 2019. In the first quarter, oil and gas production was flat due to a shut-in in Libya and slightly lower production in Russia and Romania, which was partially offset by increased production in Malaysia. Production costs were cut by a further 5% to $6.4 per barrel of oil equivalent, underlining OMV's efforts towards cost efficiency. OMV Downstream achieved a strong result. This is attributable to the contribution from middle distillate margin hedges and higher contributions from the petrochemicals, gas, retail, and commercial businesses. The retail performance was driven by strong margins and a significantly higher share of performance fuels. The refining and petrochemical margins increased as a result of lower feedstock costs. The refining utilization rate remained at a high level despite the unfavorable coronavirus crisis developments in the second half of March. Gas sales improved in the first quarter of 2020 by 26%, mainly because of higher sales in Romania, the Netherlands, and Belgium. A sustainable transformation process is now starting at OMV. One that will turn today's oil and gas company into tomorrow's gas, oil, and chemicals group. One that has a sustainable circular economy as a business pillar. And one that will remain successful well beyond 2050.